Okay, here we are. So we're welcome to the computer screen. We've got this calculator, this online mortgage calculator. It's called Rowles Mortgage Calculator. I'll put the link in the comments section below for your interest, so then you can use your own numbers and play around with it. So let me just walk you through it. So here we have the principal. So I've put in there 210,000, which just slide that along. You see it adjusts as you make it adjust it. Then I've put in here interest at 4. Again, you just slide that along to change that number. So I've put 4%. 25 years. There you go. You change that term again. But let's just using the exact example to be consistent. And then your start month, you can choose start year, etc. So here's a summary of all of that data, or the inputs. So property value, I've put 210,000, interest rate at 4%, and term over 25 years, which gives you a payment, a monthly payment of 1,108 to pay each month. Start date, end date, 25 years. This would be your total interest you pay for this term. So 122,537. That may not surprise you. That's what people normally expect to pay for an amortized long-term mortgage. So your total payments of 1,108 come to 332,000 for that time frame. Now, our objective here is to reduce this interest part. So firstly, let's just get into the normal way of reducing that, which is additional payments on top of your mortgage. So I'm going to demonstrate what an impact a small amount makes. So here we've got denominations of monthly, semi-annual, annual, and one time. So let's start off with a one-time payment. So as I put in figures here, this data, this number will change. So note there, it's 25 years, your interest is 122. So if I plug in here, look, $1 or £1, you can see £1 actually is a saving of £1.70. Not much, but make that 10. So £10 is a saving of £17 and 5 pence. So again, nothing to brag about. Let's make it 100. And then you go. You can see the more I put in, the more it's going to save. So £100 is actually saving £170. That £170 comes off of your interest, and obviously your 100 comes off of your principal. So now we're making it 1,000. So this is a one-time payment of £1,000. An additional payment on top of your normal monthly payment, just one time, saves you £1,697.84. That also reduces your term by 2 months. Look, so that's the impact of just a single 1,000 deposit. But as long as it goes to your principal pay down. So whenever you make additional payments, please make sure it's being allocated to your principal pay down. Because if it goes to a normal payment, it'll just go to interest, which won't effectively save you much. So that's a single payment of 1,000. Let's make it 10,000. So you can see this visually changing, but just a one-time payment of 10,000 saves you £16,000 and reduces your term by 1 year and 11 months. That's 1,000. I actually want to show you a 12,000 difference, and I'll get into why that in a minute. But 12,000 one-off payment saves you 19,000 in interest savings and reduces your term by 2 years and 3 months just for a single 12,000 deposit. So I'm stressing on that because many people don't realize what an impact just a one-off additional payment would make. So now we can see that. Let's just delete that back to 0 and change it. So I picked 12,000 there and change it to a monthly payment of well, if I just start with 100, if you're just adding £100 a month as a monthly contribution on top of your mortgage payment over the term, that brings your savings down to 18,000 or up to 18,000. So you're going to save 18,000 knocked off of your interest payments because you're adding £100 a month additional contribution towards your monthly payment. And notice here what it does to your term. It brings your term down to 21 years and 9 months. Remember, it was a 25-year term. So that's a saving of 3 years and 3 months just for an additional £100 a month. So if you do have the surplus cash and can make that 1,000, look how much that saves you. That saves you £76,907 in interest expense. bringing your interest expense down to 45,000. Remember, it was 122,000, right? So just by paying an additional £1,000 a month, bringing your term down to 10 years and 2 months, so just over 10 years for an additional contribution of 1,000. So this is the impact of additional contributions to your mortgage. And again, you must make sure it goes towards your principal pay down and not your regular payment. All right, so £1,000 a month could knock your term down to 10 years and 2 months, saving you 76,000. Now you might say, well, £1,000 a month's a lot of money, I can't afford that on top of all my other expenses, which is I can understand. So out here in Tokyo, where I'm based, I actually work with a lot of expats, and a lot of expats get an annual bonus or a yearly tax refund. In fact, everybody around the world may be in a position where you're getting an annual bonus of some kind, an incentive or commission or a tax refund. What I'm suggesting here is, if you can't do the monthly payment, is allocate that bonus towards an additional contribution to your mortgage. So let's put that over here as an annual payment rather than a monthly payment. So let's stick $1,000. Let's stick $100 a month, or £100 a month is 12 months is 12,000 a year, right? So there's your, or 1,200 a year, sorry. So there's your 1,200, equivalent to £100 a month. That'd bring it to 21,000, but it's more likely for a bonus, it's more likely going to be 12,000. So with a 12,000 annual payment, one time when you get your bonus or when you get your tax refund, allocate 12,000 towards your mortgage principal pay down, and there you go. It brings it down to 10 years. So it actually knocks off a further 2 months rather than paying $1,000 a month. So what annually, when you get your bonus, contribute 12,000, saves you £79,627 in interest payments, and brings your payment term down from 25 years. It reduces it by 15 years down to 10 years. So this is how you can pay off your mortgage in 10 years if you've got some kind of bonus or annual amount equaling 12,000, and can put that onto your as additional payment once a year. Now, if you're in a position where you could do that twice a year, then let me just show you what happens. So this is a semi-annual payment, so an additional contribution twice a year of 12,000. Look at that. Your mortgage is paid off in 6 years and 1 month. That's amazing, right? 6 years and 1 month. So it's a reduction of 18 years and 11 months, saving you $95,660 in interest payments just for this additional contribution. And again, as long as it is allocated to the principal pay down and not towards your regular payment. This is what you must make clear if you're going to do this. So there's a massive saving there, clearly. And of course, we would all want to be in that position. Now, some people don't have that additional cash flow or that surplus money to be able to do it. So remember, I said in the beginning, anyone can do this, even without the additional surplus. So what I'm going to show you next is how to achieve this semi-annual payment without having your cash in your bank. So let me just bring in now and again, before I go into that presentation, I will put the link to this calculator in the comment section below, so that you can plug in your own numbers and play around with it and just use it. It's a very good tool. In fact, if I've got my phone here, they've also got an app as well. So on your app, look, using the same, I've put the same numbers on the app. I don't know if you can see that. So on here you can see the same summary details and same app. So you can either do it on your app on the phone, it's a free app, or you can do it online with the internet version, which I'm using now. So let me just bring over my final part of the presentation for those without this surplus cash flow to achieve the same result in a different way. Right, here we are again. This is the really interesting part, and it's going to bring it all together about why was I talking about credit cards earlier, why was I declaring that or stating that anybody can do this even without additional cash in the bank, Well, this is it. This is where you're going to learn all of that. So pay attention, focus, turn off your phone and listen intense. Okay, so the typical cash flow of a normal working person is this. So we receive our income, it gets paid into a bank, and this is for the same for most people. We have our expenses, our living expenses and our regular bills that we pay, and then whatever's left is left in the bank as savings. This is just not factoring in anyone that invests and other income streams. So just a typical salary and cash flow scenario. So okay, so here's your family using the numbers that I've spoke about with using the Carl's mortgage calculator. Again, the typical cash flow scenario. So on this person, I'm relating to a person that earns $60,000 a year, or it could be £60,000 or whatever currency that you're thinking or operating. So 60,000 a year is 5,000 a month. That would be paid into the bank, as you know, typically. This particular family has a 15,000 credit line. That could be on a credit card, or it could be a home equity line of credit known as a HELOC loan, or some kind of credit line. But I'll just use credit card as an example. He has on this property he owns, his mortgage payment is the $1,008 per month as a mortgage payment, and to pay this 12,000 balance he's on his credit card, his monthly payment is $600 a month. His normal other additional or her additional living costs are coming to $1,980. Now I've just used that number as an average and to round off the numbers. So again, you could work this out using your own numbers and make it relevant to you. So out of a 5,000 salary net of any taxes, this is what is actually being paid into his bank. After paying his $600 a month credit card, it's $1,008 mortgage, his other living costs, he's left with $1,400 that's usually saved in the bank. Okay, so that's the setup I'm talking about. Now, his mortgage balance, all I've added here, this is his salary, which I just went through, his line of credit, his $1,000 a month for his mortgage, his $600 for his credit card, his living expenses is $1,400. So exactly the same as I just went over, but I've added in here the balance debt of his mortgage. So he's got a $200,000 mortgage over 25 years in this example. In actual fact, I think I used 210 in the other example, but for this example, it comes at 4% fixed interest. It would be $1,008 a month and change, so 1,000.45 or something. So there you go, that's the scenario. Now, to achieve this, all I'm talking about is changing just two dynamics of this typical cash flow structure. So instead of allowing the money to be deposited to the bank or paying to the bank, all I'm going to do is going to skip this step. And by skipping this step, what I'm saying is pay your salary direct to your line of credit. Okay, so I'll say it again. So instead of your salary being deposited straight into your bank, instead your entire month's salary, put it towards your line of credit. Now you might think that's a little crazy, but hear me out and follow this step through and you'll see the logic of that. So there we go. That's just to demonstrate the movement. That's the one change at the moment. So this was before the normal typical structure, and then this is after. So the change is this: instead of paying to your bank, you pay to your line of credit. All the other variables or inputs are the same amount of mortgage, same amount of credit card, same amount of living expenses, the same line of credit with the same debt on the credit card, same balance on the credit card, the same money left over, and then these are the terms of the line of credit or the credit card and the terms of the mortgage. So the mortgage is the same, 200,000 balance over 25 years, 1,008 per month at 4% interest. Your credit line is 50,000 credit line, available credit. You've got an outstanding, or this person has an outstanding balance of 12,000, which is now obligated to pay 600 per month. His APR is 21% on that credit card. So I've factored in a higher interest rate compared to a lower interest rate for the mortgage. Now this is where people stumble as well. when you're comparing interest, as I was alluding to earlier, it's not the number that's important, it's how it's treated. And where people go wrong is they focus on, this is not a like for like comparable, because this is amortized and this is simple, which I explained earlier. So people focus on the payment amount, how much do I pay a month, and they live on a minimum basis. So I want the minimum payment per month, and this is what holds them in, perpetuous debt, by focusing on minimum, paying back minimum, just doing the bare minimum. Whereas what you're going to see now, it's a big difference if you change that thinking. So okay, so, and remember, on a credit card or line of credit, the interest is calculated on the average daily balance. So when you pay a mortgage payment, it doesn't matter in the month when you pay it. You can pay it at the beginning of the month or the end of the month. It makes no difference to your interest being charged. But on a credit card, it does, or a line of credit, it does. So if for most of the month you had zero balance, then you had a balance at the end. You've only got one day holding that balance. You've got 1 day. Your average daily balance is being a lot lower than holding it for the entire month. Also, it's revolving credit instead of fixed. So revolving means you can reuse that money, that credit line. So you could pay back the credit and then reuse it. So it's revolving, just as it explains. Okay, so the only change I'm making is, instead of paying to the bank, you pay to your line of credit, your salary. You pay your salary towards a line of credit, and your line of credit then pays for your expenses instead of coming from your bank. So that's the differences. So as you go through it, because it's going directly to your credit card, for example, then obviously you don't need to worry about that. It's already automatically taken care of, because you're not paying 600, you're actually contributing 5,000. And then from that 5,000, you pay your 1,000 mortgage and your 1980 or £2,000 living expenses. And that again would leave you with actually the 1,400 plus the 600, because you've already knocked that off the list. Okay, does that make sense? Well, let me show you that visually, that it'll be easier to follow. So here's your starting with your 12,000 balance on your credit line. Okay, remember, you got a credit line of 15,000, but you're starting off with a 12,000 balance. You already got a debt of 12,000. So your salary comes in, the 5,000 comes in, that's this number here. So your 5,000 would reduce this balance down to 7,000, but you have 3,000 living expenses. Remember, so you can see that your 3,000 is your living expenses and your mortgage payment added together is the 3,000. So to recap, you got a 12,000 balance on your credit card or on your line of credit, your HELOC loan, whatever it is. I'm using a credit card, for example. Your 5,000 deposit, your 5,000 salary comes in. That reduces your 12,000 down to 7,000. But you still have 3,000 expenses, your mortgage payment and living expenses. So that is paid from your credit line. So that raises your balance back up to 10,000. Do you follow that? So you start off with 12,000 balance, your 5,000 salary comes in, you spent 3,000 on expenses, that leaves you with a balance of 10,000. Your interest for that period would be 212 interest. Remember, it wouldn't be exactly that, because it depends when you put, as the note down here, it depends when you put the credits and debits on. The average daily balance could lower your interest amount, but I'm just using here as a maximum. So now you're at 10,000. So again, you repeat this process, and these are the months along the bottom. You repeat this process. Your salary comes in, your 5,000 comes in. It takes that salary, that balance down to 5,000, but then you've got 3,000 expenses. So now you're back up to 8,000. And again, we're going to repeat that process, and that was your interest charged. You're going to repeat that process. So you've got a debt of 8,000 on your credit card. Your 5,000 salary comes in, and then you pay your 3,000 living expenses. And of course, that then leaves you with 6,000. So your balance is reducing because you're lowering your average daily balance, and you're reusing the credit line to live off, to pay all your expenses. So repeat again. So in comes your salary, out goes your expenses, and you're left with a balance of 4,000. And again, this is the interest for that month reducing as well. And then again, you repeat it in June. So your salary, so you've got a 4,000 balance. Your salary comes in 5,000. You spend 3,000. You're left with 2. Your salary comes in 5,000, which takes you to negative. Takes you to -3, and then you spend 3, puts you at 0. So what's happened here is over 6 months, you've just cleared a balance of 12,000 on your credit card while maintaining your living expenses and paying your monthly mortgage. But now you've cleared your credit line to 0. So now what do? What would you do? Well, if it worked, if you could reduce a 12,000 balance in 6 months, wouldn't it make sense to do it again? So now what you would do is you go back to the beginning. You spend 12,000 from your credit line and you add that to your mortgage. And it's important to make sure it's capital pay down, not interest payments, not a regular payment. You must declare it must be allocated to capital pay down. Now, by doing that, you've just knocked off another 12,000 off of your mortgage. And you remember the numbers on the calculator earlier, how much difference that makes. So 12,000 now can be knocked off of your mortgage balance. And then you repeat this process. Your salary comes in, you're using this credit line to cover your mortgage payments and live off because it's revolving credit. Repeat that for 6 months. This means if you've got access to credit or a credit line in some form, whether you can do it on a credit card or a home equity line of credit, a HELOC for example, or some form of revolving credit which is billed in a simple interest method, you could use this process twice a year with a 12,000 balance, 12,000 debt. That means you, in conclusion, you get to that same moment where someone is adding or paying off £12,000 or dollars off of their mortgage debt twice a year, because this takes 6 months. So if you keep repeating, you do it twice a year, every year, and then you're paid off in a much shorter amount of time. So remember, on a mortgage, this is your monthly dates. This is your total monthly amount on your mortgage. That was your balance reducing. Notice it's separated here. Your interest part is the bigger part of the payment. Your principal out of it, this is the £700 of that 1,100 goes towards interest, and only 408 goes towards principal pay down. So if you add up those 400s, it would take you 2 years, just over 2 years, to pay off £12,000 from your mortgage balance. 2 years. And I've just showed you in 6 months you can do it with a credit card or a line of credit. These numbers didn't change, it's just that you've reduced your principal because you've lowered your balance by 12,000. So think about that. It takes 6 months on a credit card to clear a 12,000 balance and live off it, whereas the traditional way, it takes 2 years. Is this making sense? Is this obvious now? This puts you in a real good position if you can just reallocate how your salary is paid and what vehicle you're using to pay your expenses. Okay, great. Thank you for those that stuck around. Thank you for following the process all the way through. I hope you found it of value, and it's something that maybe you could look at exploring, allocating within your own financial cash flow. So hope it works out for you. Do remember, with lines of credit, the one negative that I can identify that is line of credit can always be cut or reduced or taken away from you. So keep some cash, surplus cash somewhere as a backup, but do remember that credit lines can be taken away or called in early without notice. So that's the only negative I can think of, so do keep that in mind when you're exploring this structure. Many people already do this all around the world, so it's nothing new. All this is really about is just refocusing our mind and just looking at our cash flow differently. That's all it is. So good, please give me a thumbs up if you liked it. So in my next video I'm planning on doing strategies around expanding or buying investment real estate and structuring them inside of an LLC. Because within an LLC, there's many advantages. There's tax advantages, significant tax advantages. There's liquidating advantages. So when you want to sell your property, it's actually much easier, much faster, and much more attractive to a buyer when they're buying it within a company structure. And I want to get into that. So, and then other strategies around investment real estate. I'm going to put a link in the bottom to a ebook for a guide for expats who commonly find it difficult to raise finance for investment mortgages. We specialize in that, so look out for that ebook on mortgages for expats. That'll be in the comment section below. But apart from that, thank you again. Subscribe, like my video, share, and hopefully I look forward to seeing you in my next video.